BHP has posted its lowest profit in 5 years. That's as sluggish demand from China weighed on iron ore prices. But looking ahead, the global miner says it expects demand for its commodities to remain resilient, even as the global economy faces an uncertain environment due to shifting trade policies. The firm has also raised its net debt target range to between $10 and $20 billion. The company noted this is due to technical analysis and isn't a sign of increased appetite for merger and acquisition activity. Nevertheless, CEO Mike Henry has commented that BHP will consider acquisitions in target growth areas like copper and potash, but he noted that these assets would have to be reasonably priced and of a high quality, and the overlap between those factors is rare. BHP has cut its final dividend. It will pay shareholders 60 US cents. That takes the year's total to $1.10, which is the lowest payout since 2017. Harmony takeover of MAC Copper has received the green light in Australia. That approval by the Foreign Investment Board clears the last regulatory hurdle after the SARB gave the thumbs up earlier this month. MAC Copper owns a high-grade copper mine in New South Wales, which produced around 41,000 tons of copper in 2024. Harmony says the acquisition strengthens its portfolio and accelerates its transformation into a global gold and copper producer. Peabody Energy's abandoned its bid for Anglo's Australian coking coal mines. The US miner says it pulled the plug on the near $4 billion deal after failing to secure a lower price. Last year, Peabody agreed to acquire the mines in Queensland's Bowen Basin, the world's top coking coal region, as part of its steel-making strategy. But in March, operations at the Moranbah North mine were halted due to high gas levels. That triggered a clause allowing either party to walk away or renegotiate if a significant negative event occurs before completion. Peabody CEO Jim Gregg says the companies couldn't reach a revised agreement to offset the long-term impact of the disruption at that mine. Deneb Investments is lightening its portfolio. The company is selling its Mobeni Industrial Park in KZN, and that's in a deal worth 170 million rand. Deneb says the property is not core to the strategy and that the proceeds will be used to settle outstanding debt. Eskom has launched a new renewable energy program that will allow large businesses to buy solar power directly from the utility. This is the first time the state utility is offering this kind of deal. CEO Dan Marokane says the move is the next step in the company's plan to integrate additional renewable energy into the grid. Eskom aims to have 2,000 megawatts of new renewable projects ready for construction by 2026 and to scale up to 32,000 megawatts by 2040. This includes plans for green hydrogen production and large-scale battery storage. The Rooibos Council has warned that new U.S. tariffs could squeeze jobs. That's despite its broad global customer base cushioning the sector for now. The industry sustains about 8,000 jobs, mostly in rural Western Cape. And while the U.S. accounts for only 5% of exports, it's seen as a high potential market that supports America's blending and packaging industries. The council says prolonged tariffs could erode margins, weaken competitiveness, and dampen investment and rural employment at home. It argues Rooibos is unique to South Africa and poses no threat to U.S. farmers. As such, it's joined government in calling for urgent relief to protect the sector's long-term growth. President Cyril Ramaphosa is facing legal action to increase magistrates' salaries by 34%. In court papers filed at the High Court in Johannesburg, the Association of Regional Magistrates of Southern Africa argues that magistrates' workloads and responsibilities have ballooned since 2008, but their pay, which is capped at 1.1 million rand a year, has lagged. If the increase is granted, Ramaphosa will be put in a difficult position as it could lead to hikes for mayors, MPs and judges as well. This would swell an already strained 740 billion rand wage bill. Further afield, Nvidia is working on a new AI chip designed for the Chinese market. The chip is based on Nvidia's latest Blackwell architecture and is expected to outperform the company's current China-approved model, the H20. Here's more detail in this report.
Nvidia is developing a new AI chip for China. That's according to two sources who said the US tech giant will base the chips on its latest Blackwell architecture. They said it will also be more powerful than the H20 model Nvidia is currently allowed to sell there. US President Donald Trump last week implied the firm might be permitted to sell more advanced chips in China. But the sources noted US regulatory approval isn't guaranteed. They say Washington has strong concerns about giving China too much access to US AI technology. The sources said the new chip is currently known as the B30A and its specifications aren't completely finalized. They added Nvidia hopes to deliver samples to Chinese clients for testing as early as next month. Nvidia said in a statement, "We evaluate a variety of products for our roadmap so that we can be prepared to compete to the extent that governments allow." The US Department of Commerce did not respond to a Reuters request for comment. China generated 13% of Nvidia's revenue in the past financial year. The company only received permission in July to resume sales of the H20 after it was ordered to stop in April. The chip was developed specifically for China after export restrictions were put in place 2 years ago. Trump said last week he might allow Nvidia to sell a scaled-down version of its next-generation chip in China. That's after he announced an unprecedented deal that will see Nvidia and rival AMD give the US government 15% of revenue from sales of some advanced chips in China.
And Xiaomi's second quarter revenue soared 30.5%, driven by a surge in smartphone sales, particularly in Southeast Asia, where it became the top-selling brand. The company's electric vehicle business also contributed significantly to the growth, generating $2.87 billion in revenue. Let's take a look.
Xiaomi, a rise in smartphone sales helped to boost its second quarter earnings by over 30%. Revenue for the quarter was a forecast-beating $16.16 billion, while adjusted net profit rose by 3/4 year-on-year, also above analyst expectations. The Chinese tech company said it became the best-selling smartphone brand in Southeast Asia in the second quarter and took second place by shipments in Europe. Meanwhile, its electric vehicle business generated almost $2.87 billion in revenue during the quarter. That's up from just over $2.5 billion in the first quarter. It's delivered around 81,300 cars in the June period, over 5,400 more than from January to March. Its second EV model, YU7, was launched in late June, with the deliveries only beginning last month. That means it has yet to be reflected in results. Its new initiatives, including EV and AI, also narrowed a loss from the first quarter. Xiaomi's Hong Kong-listed shares have risen 52% so far this year.